Welcome everybody. This is the Alternative Finance panel. This is the, I think, third or fourth year that we've done this together. Some really terrific, esteemed colleagues who, I don't know why, but year after year agree to do this with me, and I really appreciate their participation. David Schonbraun from SL Green, Andrea Balkan from Brookfield, Peter Sotoloff from Mack, and Michael May from Silverstein, and we're waiting for Kevin Egan from Oxford. And really appreciate you all being here today. What I thought I'd do is let you all introduce yourselves real briefly. Please try to make this as interactive as possible, interrupt each other. I know that you're all chatty and talkative, which is fun. We have 50 minutes to talk about a bunch of topics and have some lively discussion. So why don't I kick it off with David, say hello and tell everyone what you're up to.
Hi, David Schonbraun, Chief Investment Officer of SL Green. We're the largest owner of commercial space in the city. We focus mostly on owning office buildings. We also own some residential and some street retail. And then on top of that, we have a lending business primarily focused in New York, where we do bridge and mezzanine lending kind of on all the different asset classes.
Great. Michael?
Hey, Michael May, the president of Silverstein Capital Partners. We're the lending arm of the Silverstein organization, which is a large office and multifamily owner in New York, the boroughs, and some other locations as well. On the lending side, we focus on levering off of the expertise of Silverstein on development, construction, all the facets that of the businesses that Silverstein runs, and we primarily do bridge and mezzanine lending.
Thanks. And Andrea?
Sure. I oversee the debt business at Brookfield. So we run a series of open-ended, closed-ended funds and separate accounts, all focused on mezzanine exposure. So, our strategy is pretty simple. We originate loans, we sell a first mortgage, and we create a mezzanine loan for ourselves to keep.
Great. And Peter?
Yeah, thanks, Marty, again for hosting. I'm Peter Sotoloff, co-founder, managing partners, CIO of Mack Real Estate Credit Strategies. We're a institutionally capitalized alternative lending platform, generally doing large loans with institutional sponsors. We provide mezzanine, first mortgages, preferred equity, and other types of securities investments as well from time to time. We have about a 35-person dedicated debt team, in addition to a broader 250-person development equity, kind of long-term hold equity investment and development strategy.
Great. So it's been a wacky 7 or 8 months in this pandemic era. Just wondering, over the last 7 or 8 months, has this created opportunities? And have you done deals sort of because of the pandemic? How has your business changed through the pandemic? Why don't you start, Peter?
Sure. Look, we had been preparing for a number of years for some correction. We talked about it at our annual investor meetings. And what was very, very concerning is we didn't know what it was going to be. We obviously never predicted a pandemic. And but what we immediately did kind of late February, early March is we drastically culled our pipeline. We had about a $4 billion pipeline. We thought that, given the uncertainties associated with an open-ended event like this, it was important to preserve liquidity, frankly, and batten down the hatches with our existing loans or borrowers, make sure kind of that board is built. I think, once we kind of had control over that and we had, basically transitioned most of our origination team to become investment managers, asset managers, portfolio managers. But once we felt we had good coverage of that, we did embark on some very select opportunities, mostly securities purchases, in addition to a bunch of rescue financings on New York office, for instance, we'll talk about later, some hotel for some public REITs. But, again, shadows of what it once was. We did about $7 billion of originations last year, definitely have retrenched and kind of reevaluated as obviously we don't know the length and severity and the impact on that this crisis will have.
So what do you think you'll do in 2020?
Yeah, no, that's a great question. Right now, we're probably tracking about $2 billion. I think some of that candor candidly is we have future funding obligations with our existing borrowers. We have very good floors in place on those loans, very good assets. The borrowers have been very committed. We've been very impressed, frankly, with the level of commitment all of our borrowers have shown us, with maybe one or two exceptions. And the idea here is that that's an embedded source of really good return for us, in addition to obviously the new opportunities in our pipeline. We went to committee last week. We have about 7 or 8 new opportunities that we either signed up or are closing. And but we expect, unlike the past, call it 3 or 4 years, to be very selective until we really have a sense of how the impact is to values, and that we're really out of the woods here, even if we've had some good news this past week on some very exciting vaccine developments.
And would you say you did any deals because of the COVID pandemic?
Yeah, totally. We couldn't provide. We have a public REIT borrower that actually came to us for a 30% loan on an almost built hotel in a very good market in California, where it's not a luxury product. It's more extended stay oriented, which actually is performing better than pre-crisis levels. They gave us about 100% recourse. We got an L900 rate at 30-some% loan to cost, and we said, look, we don't have a lot of hotel exposure in the book. This is a good way to leg into some of that on a selective basis. Sponsor we've known, similar to like a Brookfield, very, very institutional, very well capitalized, committed to their assets. And so we decided to do that. Another one was we had an office building mezzanine loan for $120 million. We provided at basically $350 a foot. The land value, 92% leased, 1 million square feet. Sponsor needed liquidity for other areas of their portfolio. We did that at about a 15% rate of return with a nice multiple. And so that probably wouldn't have occurred but for liquidity-induced and pandemic-related issues. We would never been able to do that before COVID.
Great. I'm told that Kevin Egan is on by phone. Kevin, can you hear me?
I can. Hello, everyone. Sorry for being late.
No, that's all right. We all have technical difficulties sometimes. Do you want to just say hello to everyone and describe who you are, since we can't see you?
Yeah, sure. Yeah. Well, I've got a face for radio, as they say. So I'm Kevin Egan, head of investments, head of North American investments for Oxford Properties, including our equity and credit book. Purpose of today is credit. So we've got a pretty active book. We're about $4 billion in invested capital. We invest up and down the capital structure, looking for best risk-adjusted returns. And this year we've been active, but the deal size is maybe a little smaller than usual. We've put out about $500 million of equity so far this year.
Great. And Andrea, you want to talk about the last 7-8 months?
Yeah, it's been interesting, right? We have pretty much stuck to what we generally do. We probably will close on about $1 billion of mezz, so 2 to 3 billion of whole loans. Most of that is post-pandemic. A couple of them were deals we were working on pre-COVID that didn't end up closing until we were, all back in the office over the summer. We've done a lot of the, ordinary stuff that we usually do. We've done a couple of office buildings, one in New York, one in Chicago, doing a large construction loan on the West Coast, seeing a lot of interesting multifamily deals because a lot of multifamily is not 95% occupied. It's 75 or 80, so it can fit one of us. And seeing some construction opportunities where, maybe the banks are a little less excited, a little more conservative, or the borrowers are really, I don't know what you guys think, but I feel like the borrowers are valuing certainty of execution more than, the last nickel that's promised to them but may not happen. So kind of from a macro theme, that's what we've been seeing the most, where we're issuing a quote and the borrower is not necessarily going 10 runs on the term sheet and shopping it to everybody in the world, but actually saying, okay, we're going to take this as long as it, tighten a little bit, but we're going to take your terms and move on. So I don't know if other people have seen the same thing. That's been a nice benefit to the pandemic.
You guys all agree that's a pandemic theme? Getting easier to get deals done with borrowers who just want to get deals closed, right?
I would agree with that.
What's gone on for us the last 7-8 months? You've been busy building our business?
Yeah, being, I said, one of the newer kids on the block was, I think, helpful. going into the pandemic. We had really not, we've done a handful of deals, but they were all construction. So as I said to some people, with no cash flow, you have no cash flow to lose. They're being delivered in 2022, 2023. So we really focused on that part of our portfolio and just making sure that there weren't hiccups in the construction or that our projects were adequately capitalized for delays. But we weren't really doing blocking and tackling, looking in the rearview mirror and trying to figure out where the problems were. So that was really helpful, and that allowed us to focus forward on trying to do new deals. And so we aggressively went out and tried to buy some loans. We bought a loan from David more at the end of the summer, but right at the beginning of COVID, we're out in the market looking for deals to do. And I think what we're finding both on the secondary side and on the primary side is people just want surety of execution. If you're selling a loan, you want to sell it. If you're looking for financing, you want to make sure that the deal closes, then it closes and in a timely way. And I think across the board, a lot of the folks that were competing with us that perhaps hadn't done kind of this heavy lift construction before are now back out of the market. We're working on a deal right now, which a hedge fund that had come in on a bespoke basis to do a construction loan, close the loan. Then the hedge fund had all sorts of corporate issues and is unable to fund. So we're stepping in quickly to backfill a project that the sponsor's funding out of equity. And the rates on things that we're seeing, instead of being 300 to 500 over, are 1,300 to 1,500 over. So I think that from our perspective, COVID's been good for the business. Obviously not good for the world or the market, or many of us personally, but it's presented a lot of opportunity to see deals that make a lot more sense at much higher returns than we were seeing before.
And David?
Yeah, we're probably a little bit on the opposite end of the spectrum. I think kind of going into the end of the first quarter, we had grown the book a little bit with the intention of always selling down by year end. COVID just accelerated that. I think unlike everyone else here, we don't fund ourselves through fund vehicles. We use the REIT capital, and given the dislocation of kind of the equity REIT market, selling loans, using that money to have liquidity and buy back our stock is just a better use of capital. And so we probably sold somewhere around $500 million worth of loans, and then got repayments on $200 million more. And for us, the market's been pretty strong actually in terms of looking. There's still a lot of debt capital out there, and I think for well underwritten assets with good sponsors, you can still clear things at very good pricing. We were probably mid to high 90s on average on a decent number of loans and high dollar value, which is comforting because I think there's a lot of negativity out there. But for good assets and good markets, on the debt side, there's still a very strong bet. I think people want to get paid some level of premium just because they feel like there should be some level of stress in the market right now. But it's not as dramatic as some people would think. Heading into what April and May look like. And so I think right now we're focused on doing a little bit of monetization, and then probably looking to enter back early next year. Now that there seems to be a little more certainty and clarity. Obviously, it'll take a little bit of a while for the office market to completely come back and know exactly how everything shakes out. But I think with all the recent news, there's definitely more comfort and kind of clarity into what's going to happen with the office market. And on the multifamily market, we sold all of our condo exposure down. It wasn't high basis, so it would work as multi, but for us, it's not really a core investment. But I think you'll see some pain in the condo market just because it takes longer to sell some of these units. The carry just kind of grinds away and eats away at the sponsor's basis. And then in multi-assets, even though you probably have asset value being protected because you're losing occupancy right now, the sponsors who put on more leverage are going to have to reach into their pockets when they weren't expecting, just because in the short term, while people have moved out of the city, while they haven't been kind of coming back to the office, you've seen people, I think more on a short-term basis, move out and occupancies drop. And I think that's stressed a lot of borrowers kind of making debt service payments where they kind of were expecting, easy coverage and had never underwritten, 10, 20, 30% drops in occupancy.
Thanks, David. Hey, Kevin, has your pipeline increased or decreased during the last 7 or 8 months, and how do you think that's going to change in the future?
Initially, the pipeline activity picked up dramatically, largely due to a competition kind of falling by the wayside and folks looking for certainty of execution, and we still had a strong balance sheet. So we saw that pick up initially. Then I think there was a little bit of a lull as everybody was trying to figure things out. If you didn't need to borrow money, you didn't want to borrow it. It was only sort of rescue situations or liquidity situations. And now we're starting to see it pick up again. All-in rates for sort of the haves in the world are still pretty good. The have-nots are, there's some untouchables out there, and there's a whole bunch of stuff in the middle. But we're seeing activity pick up, and we think that trend will continue. And we're pretty bullish on our ability to deploy capital because we do think that a fair number of our competitors are sidelined now. So until folks can shore up their own balance sheets and how they lever their own book, I think we have a window over time that we can put out some pretty attractive capital.
And Peter, it sounds like you did less deals this year than last year, but it sounds like you're ramping back up.
Yeah, look, it's all relative. I think, we had pipeline this past week where we had 7 or 8 opportunities. I would say we're definitely, we've historically been New York and major city focused. And I think, we made an effort before COVID even to try to diversify more into other up and coming primary 18-hour cities. And I think, we've been letting a number of our urban assets roll off. We got 3 repayments this past quarter, all New York exposure. So I think we've just, given just the situation and uncertainty in these markets. And I know, Marty, you're a huge bolster of everything New York and urban. But I think, we've been kind of concerned about some of the trends going on. And I also think, just in terms of learning, it was a rude awakening for a lot of us where things that we thought were once safe, New York City office, New York City free market, residential, it's a big shock. And I think, credit to you, Marty, as a leader in the industry to get people coming back into the city and being a torch, bearer for that. But I do think that before, free market or any kind of New York City rental comes back, the bosses have to be saying, get back to work, come on back in and sign leases again. Hopefully people will start signing leases again. But definitely as a lender with all the downside and none of the upside, everything kind of that we thought once was completely 100% durable and no-brainer, bulletproof kind of lending, clearly COVID was definitely a bit of an awakening to those types of sacred cows, so to speak.
I agree, and we don't never count New York out. It's going to take some time, but we'll be back. But you touch on an interesting point where I know for our book, and I'll let Michael talk about it, we did expand to some new markets, and I'm wondering if others did. Michael, why don't you talk about how we're venturing out of New York, and I'm wondering if you others have broadened your horizons as Peter did.
Yeah, well, we absolutely. Our strategy was to initially focus on New York just because that's where Silverstein's biggest footprint is, but was always to go national. And what we're trying to do is find markets that have really strong employment trends and growth trends, but are large enough in scale to warrant an investment there. So most of our deals are 50 million and up. So it's hard to find some of the maybe high growth other markets, like even in Nashville. There are a handful of deals, but not a ton that are of the scale that work for us. But we're looking at a deal in Austin right now. It's the #1 market for job employment growth, which means it's lost the fewest jobs, but they're almost back to flat as of this past month. And I went down and walked that market and spoke to the brokers. I walked into a condo building, and they're selling 10 units a month, or about 20% of their inventory every month. And I'm saying we've gotten a bunch of market research showing the same thing. So it's certainly a strong market with a ton of tech growth. We're looking at Bellevue right now. Amazon added 25,000 jobs to Bellevue during COVID, which is the same as HQ2 down in DC, and that's just one tech expansion. Facebook's there, Microsoft's there. That market's absolutely on fire. So we're following markets where jobs are and where growth is still good, and some of those markets still exist. New York has population leaving. Some of the fundamentals aren't as strong. Like Marty, we believe in New York, and we like buying well below replacement cost or lending at significant discounts to replacement cost where we feel safe over time. And sponsorship really makes a huge difference in those situations. We're finding you could do an okay sponsor, well sponsored deal and do better than you can in maybe a slightly better poorly sponsored deal, just in terms of how the sponsors behave. But we're looking all over for places that we can find growth and strong fundamentals, and that's absolutely a shift. As there's absolutely a shift since COVID. And the last thing I'll say, when I was in Austin, and I was speaking to people about who's moving there and who's buying there, they said it's the high tax states. It's New York. They said 100% of our buyers are moving here for good from New York, Chicago, and California. So I think that trend of warm Sunbelt states and low taxes is going to continue to drive growth in those markets.
How about you, Andrea?
Yeah, I would say, we're still believers in New York. We're still doing deals in New York. One of the first post-COVID deals we did was an office building in New York. But we're seeing a lot of interesting opportunity in other markets. So we're doing a construction loan in Hawaii, places. We've always done deals in London, but we're also doing a deal in the Netherlands right now. We've done a large industrial deal in New Jersey. So we're just doing kind of a little bit of everything, still looking at fundamentals. If we had a discount to replacement cost, are we in a gateway city? Are there barriers to entry? What's the price? What's the discount to replacement cost? And so it all depends on the specific asset. I will say the deal we did in New York, pre-COVID, we would have lent more than we lent on post-COVID. So kind of values came down. We lent, equal to or less than we would have lent, but we had a much thicker slice of mezzanine and, a higher return, reflecting the fact that we're underwriting more conservatively given the realities of what we're dealing with. So I would say we're not blind to what's going on in New York, but we think anytime other people are panicked and some of our mutual competitors are kind of redlining certain areas, there's always opportunity to do good, safe deals. So if you've got an office building and it's got a long-term leases and it has very little role in the next few years and private tenants, then, it's something we're going to consider.
Right. Kevin, what markets is Oxford playing in, and has that changed at all?
Yeah, interesting times. Great for this question. So the 12 months leading up to COVID, we had been shifting our focus away from retail, hotel, and even office. And historically, we were a gateway city investor. And we started, really legging into industrial, life science, and residential, actually, in sort of those high growth red states that one of my panelists mentioned. So that kind of mirrors our equity book. So that's where we've been focusing. And that was a pretty big shift. It's kind of ironic that the gateway cities have almost become the special situations book right now. And the Sunbelt residential has become core. But we're, that's kind of the way we shifted over the last 12 months. And post-COVID, we continue to go with those themes. A lot of industrial and life science. There's no shortage of capital on equity or debt chasing those. Initially post-COVID, we chased some discounted bonds on the screen, some rescue capital, and the like. But it is interesting that we've shifted away just because of our portfolio capital allocation strategy, but it has happened to mirror sort of the trends with COVID coincidentally.
All right, thanks. And Michael, you hit on this before. It sounds like the deals we're doing today are getting higher yields. Is that a trend that everyone's seen during this pandemic, Peter?
Yeah, again, this is, going back many cycles of doing this, these are when the opportunities present themselves during this dislocated time. I think it's tough in this situation. There's a lot of positives, banks in better shape, tons of stimulus, a lot of dry powder from institutional investors being allocated to the space and sitting on the sidelines, more coming. So I think there's a number of good factors that create a very attractive investment environment if you believe at some point it's 2, 3, 4 years. I think, we definitely are proponents and long-term bulls on urban markets. We think people will come back. But I also think that as a debt manager, diversity and stepping into other growth markets, we agree with Kevin's comment wholeheartedly in terms of where the trends are, where people are moving to basically more tax effective regimes, more pro-business regimes. That's real. We're seeing it in our loan portfolio, our pipelines, and I think that's a fertile ground for us to diversify while the major cities work out, or hopefully work out, a number of these issues that obviously create some headwinds.
Right.
I think, Marty, this is every situation's unique. I think every downturn is caused by something, but this pandemic, I think, is so different than anything, in the last 20 plus years in terms of how lenders are reacting as well. I think there's a lot less deals out there, and some of it is because there's almost a little bit of a pause in the world, and a lot of lenders are kicking the can down the road and kind of extending things or letting people go non-accrual, and because this was caused by such a different reason and affecting kind of everyone, there's a little bit of more leniency being given, which is probably delaying any distress, and maybe because you'll have a vaccine, people will get through it and kind of maybe pay off higher balances on the back end, that you're not seeing a need in a lot of instances for as much rescue capital and as much distress or people who have to transact, because I think a lot of people are kind of working with their counterparts, and trying to be as fair as possible and being a good partner instead of trying to be too opportunistic, which I think has been healthy for the market and kept a good level of stability in it.
Right. It's a really interesting point. I know the deals that Michael's done so far during COVID at SCP have been more liquidity driven than distress driven. And just curious whether the panel feels like the distress is on its way. Is it coming? Or are we going to continue to see deals that are more liquidity driven than distress driven?
I think it all depends on how much longer, the COVID situation lasts. We saw deals, we've seen liquidity driven issues, but we haven't seen a lot of distress. And what we saw was borrowers getting, short-term deferrals. And then when the deferral was over, particularly the 6-month deferrals that ended around now, the borrowers are looking at, light at the end of the tunnel and saying, okay, if I know there's a vaccine and I'm going to be normal by summer, I'm going to, spend money on my property. It might be ugly for the next 3 months. So there's a real disconnect, I'm sure you guys will see, between the news, which says we're going to 4% infection rates and, wear your mask, before you, walk to the bathroom in the office. And, the outside markets, the equity markets, and, our borrower response, which is, hey, it'll be good times ahead. It's just, maybe 9 months away.
Right. Kevin, you were going to say something?
Yeah, I completely agree with all of those comments. So, it really, for the bulk of the market, I think it comes down to the shape of the curve, right? How is it a V, a W, a swoosh? All the analogies we've talked about, the duration of the pandemic. I think when you see a light at the end of the tunnel, it's a lot easier to underwrite how to get to the other side for both the equity and the credit. When you don't know how long it's going to go, the day of reckoning gets accelerated. So I think this news about the vaccine is going to, obviously give everybody a positive shot in the arm. We had been seeing mostly liquidity issues, as you were talking about, and it was liquidity to get to the other side. So some folks would pay up because they thought that duration of illiquidity would be longer, and other folks wanted to gamble and not pay up. But I think with the optimism of the vaccine, I think it'll continue to be liquidity for most of the market, unless that ends up being a false start, in which case the real distress could come. That said, there's sectors that have tremendous headwinds and geographies that have tremendous headwinds, regardless of a vaccine coming back. Retail's still going to be brutal. Hotels still going to take a while to come back. Condos in certain markets are still going to be overpriced. So I think it's liquidity for some asset classes, and I think there's some distress that's still going to come in a quarter or two on those assets that probably changed significantly just from a supply demand and just basic economics. So I think that's worth going.
And Peter, you did $2 billion this year. It's not $7 billion, but it's still a pretty healthy book. Were there a lot of liquidity-driven deals in there, or was it sort of business as usual?
Yeah, look, it's back to Andrea's assessment of things. These are sponsors who had liquidity needs likely elsewhere. A lot of it was, and we were able to take existing collateral that we deemed to be quite attractive at heretofore lower bases, wider spreads than anything we had seen, pre-COVID by multiples, and effectively, land value, potentially below land value with very good structure. So I would say that it definitely was liquidity, and I think even in this market, the assets that we made those loans on would clear in a dislocated market, such as during March, April, May. Obviously, still a lot of dislocation, but from those periods would still clear above those levels. Many had the one in particular we had assumable long-term CMBS debt. So yeah, most of our deals are liquidity related, not distress.
All right. I'm curious, really, I guess, Andrea, Peter, and Michael, how your investors have thought about the debt business during this time, and have they changed their thinking, and has the investor profile changed? Any one of you?
I mean, I'll start. I think that our core business, which is more high yield, has become much more attractive to our investors. I mean, our initial investors have more interest in our building, in our business. I got a call immediately before this panel from somebody that we'd done a deal with, saying that they freed one of their accounts had freed up money and they'd like to do more deals with us. We're seeing that on a lot of fronts. I think certain people have clearly left the market, but this is kind of a perfect time to be in the market from our perspective, in that, as Peter was saying, we're doing deals that are just less risky, and we're not necessarily trying to get significantly higher returns than before. We're just doing significantly less risky deals for the same returns. So we're delevering 10 or 15% for the same returns. We're doing first liens where we're doing mezzanine before. The structure of the deal, the basic underwriting is much more conservative. People don't have pie in the sky projections. They're not expecting the top of the market pricing or rents on just about any product. So when you take that whole kind of the combination of good underwriting, great pricing, lower leverage, it's a really attractive time to be entering the market if you have the liquidity to do it. And there's been significantly reduced competition because a lot of the folks are reallocating their capital, or just trying to stockpile their capital for future days, or just for better investor kind of facing financials.
And any difference between international and domestic investors?
Yeah, I think we're seeing kind of equal. We're seeing equal interest from all sides. But again, we don't have the investor base that Andrea or Peter do in terms of just the raw number of investors that we speak to.
Andrea?
Yeah, we're seeing similar. I think, investors in general like the debt product right now, especially the real estate debt product. If you look at the current returns you can get on mezzanine debt, and you contrast it to anything, whether it's high yield corporate, all the way down to treasuries, the risk adjusted returns are great. So for the most part, our investors are interested in, investing additional capital. The ones that are struggling to re-up are non-U.S. investors who may have issues with denominator effect. So either it's a currency issue in some markets, or it's an issue, really was an issue 6 months ago, that their equity book was worth less. So, when you're trying to balance a portfolio and the equity book goes down, you suddenly have too much debt if you had the right amount before. But other than those unique circumstances, which are pretty small, the vast majority of investors are looking to do more debt, whether it's with us or anyone else on the panel.
Okay. And similar feelings, Peter?
Yeah, look, we have a lot of interest. I think the one caveat to that is that you can look at the statistics. I think 18% of new pension pledges the last couple of quarters were real estate debt. I do think that people want, the number one question is where value's headed. And that's kind of, you'd be lying in terms of for particular asset classes, i.e. hotel, but it's very difficult to put your finger on that. I mean, there's sparse trades. Obviously, you can look at, David's recent trade, which is 15-year lease, B+-ish office. But, that's a unique situation. So I think that for transitional lenders, while there is a tremendous amount of interest and a lot of folks who like the thesis, low basis, high relative yields, strong sponsorship, better structures than pre-COVID, better pricing than pre-COVID. I also think to Andrea's point, a lot of folks also have been weighing their legacy books and dealing with their inherent issues. So that's kind of been some of the ballot against tremendous volume of new commitments.
Great. You feel like your average loan sizes have gone up, down, staying the same? Any of you guys?
I would say
the first quarter ours was larger. Obviously, we're selling good sized loans now, but we'd actually grown them a little bit in the beginning of the year.
Yeah, I would say actually, given our kind of conservative nature and dipping the toe back into the water, some of them have been like a mezz we did is bigger. We did a somewhat spec office deal in Nashville that was average size as our rest of our portfolio, which tends to be around 130 for whole loans. And then we did a small one on hotel because we're kind of scared of hotel, and it was all the things checked the box, but it was like a $50 million loan. So I'm just thinking through a bunch of the things. The stuff now in our pipeline is definitely a little bit back to normal size, that 130 to 250 million range in terms of whole loan size.
I would say it's across the board, but I think we're interested in doing some other smaller. We'll look at smaller loans than maybe we would have before, for a couple reasons. I think Peter said maybe to just dip our toe in the water on an asset that maybe we're slightly more nervous about, so doing it on a smaller scale. But also just because yields are higher, you can do a smaller deal and just from a net dollar return and multiple standpoint make more, and it becomes a little bit more interesting. So I think we've get a little bit perhaps more diversity, but albeit with more work. So
and Kevin's problem with not seeing you is we can't see when you're speaking. So go ahead.
Yeah, no, I apologize. So at Oxford we've dialed back size a little bit this year, partially just because that's where we've seen the better opportunities, and partially just because just making sure we have the right liquidity when COVID was kind of shaky. So last year the last couple of years we've done a lot of deals between 200 and as large as $750 million. Originate and hold $750 million, and I'd say this year the bulk of what we're doing is 50 to 150. So we still have the ability to do larger, but we're just seeing better opportunities, and this feels like a better time to spread it around or among more bets versus kind of less diversification.
Great. All right, we got 10 minutes. I have a couple questions left. I want to know, in the last year, what's your most exciting deal or most interesting deal you want to talk about? Peter? Yeah,
it's not in a loan origination. We have a trading desk that wasn't very active for a long time, and when we were in March, we started, we like relative value. I know Brookfield and by extension Oaktree do a tremendous amount higher volume than we do, but we saw some securities that were very attractive, very low bases, very big discounts from various hedge funds, and I would say mortgage REITs, others looking for liquidity. We did buy, obviously in hindsight, we never buy enough. But it was on one was on a lodging asset in Hawaii at with very strong sponsorship at land value, and those have all rallied back faster than we ever underwrote. We did an office building in New York, a Madison. We did multifamily in New York, and then some other kind of same themes. And we didn't expect it to rally as quickly as it did. They've all traded way up, but that was very interesting. We enjoyed that little journey, and that was kind of fun. It's something to do when we weren't making some loans.
That's great. David?
Sure. I think, look, Earlier this year, we made a loan on 1 Court Street with Apollo, which is a mostly vacant building on Island City that Amazon was going to move into, and then when that whole thing happened, they backed out, and the building needed to be recapitalized. It kind of shows how there's always demand in New York. We put that together in a different market than we're in now. It was well structured. We had the sponsor put in a lot of equity, and a lot of our loan was future funding to kind of lease up and redevelop the building. And we sold that loan, I guess 7-8 months after we originated it in a very different market, not that far off par. And we probably ended up, kind of even on a deal, with origination fees and carry in a different market. Because I think, if a loan is well structured and there's good sponsorship, you're going to get guys to buy at good prices. And in a market like this, where there's such low yield, people will look to put out money in New York, other kind of marquee markets, if they have what they think is a very good basis and good sponsorship. And, I think for us, that's what we've always focused on. That's why our books held up so well. So it kind of shows on something completely brand new that you can end up fine as long as you're underwriting the right way and not taking kind of undue risk.
Kevin, favorite deal of the year?
So we did like buying some paper back in March. That was a very small window, and we wish we'd put out more. But that was good. I think an interesting one was one we just closed. We just closed on a deal in California, 200 acres of industrial land that's not fully entitled, about 165 million, whole loan and sort of low to mid-teens, and we were able to underwrite that risk because we're also a developer in that market. So it was kind of cool to be able to fill in a white space where there's really no lender's home, but we're able to underwrite the risk pretty easily, given we're a developer in the space. So we levered off of our development team to underwrite that risk, and it's great risk-adjusted returns for us.
Andrea, I know you're going to have an exciting one.
Actually, I'll briefly mention two, just because they're very different. So right after, we got back to work, to the office in September, we closed on a large office building in Chicago. And, what was interesting there was it was a roughly $300 million first and $100 million mezz. And so we took on the responsibility to syndicate the first mortgage. And so we were, very proud of ourselves for being able to find, 5 non-U.S. lenders, because the U.S. banks were kind of out of the market at that point in time, especially for office. So we were able to bring together a group of non-U.S. lenders to take, all of the first mortgage. The other one we did is the opposite. It was an industrial building in New Jersey, spec industrial, but great basis, great loan per square foot. We were originally looking at it with a senior lender at 70% loan to cost. The sponsor came to us because he had gotten a competitive quote for 100% loan to cost, and we decided to just take down that whole loan and not sell a senior, because we were able to get a return on the whole loan, because you couldn't sell a senior because it wouldn't be HVCRE. We felt really good about the basis in the asset, the location, and the tenants we knew that we're talking to. So just very different ways to deal with the issue of difficulty in syndicating senior firsts.
Michael?
A couple different kinds. Look, on the acquisition side, I think we've been very pleasantly surprised with the performance of the condo loans that we're in and buying. We've bought stuff in Brooklyn downtown, and the sales are much, it's kind of it's a catch the falling knife in terms of where that market was going to go. And the sales have been significantly better than they were even last year, which is a surprise to us during the pandemic. And then in terms of new stuff, just very excited to be out in other markets doing mixed use project where there's a ton of population growth and really strong fundamentals and low taxes and pro-business. It's a very one of my friends when I was in Santa Monica said, you never would think that Santa Monica would make New York look like New York would make Santa Monica look like a pro-business place. And I kind of laughed, but it's refreshing to get out and see some other markets.
Great. So as we wrap up, I know I'm in my office. I know David's in his office. I know Michael's in his office. Andrea, where are you?
I'm in my office.
All right, Brookfield's back. I know Peter's in Watermill. But
yesterday I was in the office, Marty.
I saw Richard last night.
That's not fun, Peter.
I saw Richard Mack last night. We were on a board meeting together. He seemed to be somewhere.
He's been in the office. He's like Mr. Office, like you. Yeah.
Kevin, is Oxford back in their office?
Well, today I'm not in the office, and my tech problems of being on the phone and on the screen demonstrate why I really need to be in the office. So we're working our way back. So we'll be there soon.
Great. I guess last question for the group. Moving forward, do you think, because we have a lot of students on this call, do you think you're going to be expanding the size of your deal teams for the debt fund going forward in the next year? I see Peter shaking his head. Yes.
Yeah, we frankly, we think that there's a lot of good talent around, and we are growing. We hired actually at a senior level a fabulous woman to head our portfolio management initiatives, who's got tremendous experience in equity, real estate, and debt. And everyone looked at us. Some people like, "What are you, nuts, making that kind of high level hire in the March, April, May context?" And we just think that that's important to invest in our people and invest on behalf of our investors in talent. We're not being flagrant or about it as responsible business owners and managers, but we look at this as a great opportunity to bolster our talent bench.
Great. Andrea?
Yeah, we are actually right now adding 4 people. So we're going to bring in a head of syndication and structured finance, a vice president, and 2 associate levels of people.
Wow.
So we're in the interview process, which takes a lot of time. But
David, now that your stock's on its way back up and you're looking towards 2021.
Look, we regardless of where the stock's, every year we look to add, new young talent. I think it's kind of the lifeblood of a company. So, regardless of kind of where we are in the cycle, at those levels, we generally look to add.
All right. Kevin?
Yeah, like David, we tend to add 1 or 2 junior folks a year, regardless of cycles. So we'll probably look to do that. Our guys and ladies at the junior level tend to work on debt and equity. We sort of have a generalist pool. And at the senior levels, we may be adding, looking for some help on syndication and origination.
The other thing we did uniquely, just to add one more thing, is we did a bunch of battlefield promotions. So people that really showed their mettle during a very challenging time where we were doing a bunch of mods and working through, a number of portfolio management initiatives. We really, we saw the people that were at an accelerated basis were really differentiating themselves. So we actually did a bunch of the battlefield promotions that normally wouldn't have occurred until, probably sometime next year.
Guys, our time is up. I want to thank all of you so very much. We all appreciate the time that you put into this and appreciate every year you coming back. It's a fun panel, and just thanks for your participation. Thanks, everybody.